Well, good afternoon, investors, and welcome November, and welcome to all of you. We have a lot of dear friends in the audience and colleagues that we've known for a number of years. This is one of our favorite things to do every year, and I will start by introducing probably the person most responsible for getting me addicted to smaller, faster growing companies, my dear friend and colleague, Ken Kavula. Good morning, Ken.
Good morning, Mark. Good morning, everybody. It's a beautiful morning here in mid-Michigan, and I'm looking forward to this presentation. This is always one that goes very easily. It's easy to put together because we really like the subject, and there's a little bit of a sense of anticipation always about how well is this particular list going to do, because once we give it to you, we don't touch it. We leave it alone the whole year long, unless something happens to one of our companies where they either go bankrupt or they get bought up, and then we'll close the position. But we'll cross our fingers about bankruptcy, and we'll also cross our fingers and hope that maybe one or two of them get bought up, right, Mark?
Well, it happened last year, and Ken,
Yes,
you know what makes me happy this morning?
what, Mark?
I'm actually allowed to talk about the performance results of this portfolio because you don't let me do that very often anymore because you're so superstitious. So
Well, it worked better that we didn't jinx anything this year.
we didn't
That's a
jinx.
little bit of highlighting or foreshadowing before we actually get into the program. So
I,
without further ado, why don't we press the button and get rid of the baggage in the front end of the presentation here, this thing that we have to say every time.
all right, well, get ready for a return of the right stuff, and I think believing is a virtue when it comes to investing in this kind of stuff. So let's have some fun. All right, so here's our standard disclaimer. No investment recommendation is intended. This is entirely an educational demonstration. We obviously are going to be talking about real companies in real time. Take none of that as an absolute buy recommendation. You have to do your own homework, do your own analysis. But what we are celebrating here this morning is basically the philosophies, methods, and techniques of the modern investment club movement. Many of us are members of a broad community of investors, I would say long-term investors, but that's actually redundant, investors. And what we're going to be talking about today is the reality that you can discover and assume ownership of a relatively small, fast-growing, promising company without compromising too many of your principles. Couple of these are going to be a little bit more speculative. And Ken, that's why I added that additional disclaimer. Some of the companies that we will discuss are non-core, including early stage, and should be regarded by any of you out there listening as decidedly speculative. So if you'd
Yeah,
like,
I just want to double down on that, Mark, that we are going to include, remember that Mr. Nicholson suggested that if you think you know what you're doing, and Mark and I are approaching the point where we think we might know what we're doing. So it's okay to put, it makes very dangerous, yes. But it's okay to maybe put 15, 20, 25% of your portfolio in a non-core. So we kind of followed that kind of guidance and did include some non-core companies into our choices. We've done that off and on over the years, and sometimes we've been extremely successful, and sometimes it's turned around and bitten us in the butt. So let's hope that things go well. I want to direct your attention to the rules of engagement at the bottom of the page. A lot of our slides are not meant to be read entirely while you're at the presentation. If you want to read the entire slide, then drop Mark an email and ask him for the slide deck. And then you can go as slowly as you want through the various slides. We've done some screen capture from investor presentations, some screen captures from various pieces of information about the company. And there's not always going to be time for you to read everything on the slide. So in Mark's words, step back from the trees and look for the big picture and what we're talking about in each company.
absolutely. And if, like it says on the slide there, if you want copies of the slides or if you have follow-up questions, our two email addresses are right there on the page. So with no further ado, this is just a three-step process here. We want to talk a little bit about how we did with last year's selections in the first half, and then we're going to spend the bulk of the program talking about our selections for this year. Now, this is where, Ken, I'd like to point out that I think the audience owes me a debt of gratitude because
You say that on a frequent basis, Mark. On what are you basing it on this time?
well, this year now, you may want to go get a cup of coffee here, Ken, and maybe sip or something, because we started going through this process this year, and I asked Ken, well, what's a good favorite bank right now? And I got a list of like 20. Well, we're not going to put 20 regional banks on this list, all right? And then clearly that must have caused some type of a disruption, because the next thing I know, he is sending me companies for consideration that are not just pre-earnings, but they're actually pre-sales. I actually had to call the NSA and make sure that this was really Ken Kavula on the other end of the line. So I want to take credit up front for uh, talking Ken back into the up straight and parallel club a little bit more, because you guys would have thought it was an imposter here this morning if I had allowed him to do what he threatened to do. So there you go.
Well, I still like the up straight and parallel, and that's where I'm going to stick most of my money. But I have found an interest in some areas that we're going to talk about today, and the areas, one of them has proven to be almost immediately accretive to my portfolio. So when we get there, I'll talk about that a little bit in more depth or whatever. So this is a really nice picture. Mark, what am I looking at?
Well, you're looking at the moment you convinced me that you could find up straight and parallel in small companies. Those three pictures are from a few years ago, but they are out there, and Ken finds them, and just the fact that we're looking at these right now proves that that is Ken on the other end of the line. So good stuff. Now, it is very much a search for needles in haystacks. We go through a lot of companies during the month of October. I want to give a shout out and a heartfelt thank you to those of you that have sent ideas and discussed them during the bull sessions on Tuesdays for the last month. And it's just a good thing. And it's a wonderful feeling to see that red bar larger than the other bars. So anything else you'd
Hasn't
like
been
to
there
add?
in a while. Yeah, that red bar hasn't been bigger in a while. This is the first time in 3 years that we've put a portfolio together that has beaten the market, and we're happy about that.
Absolutely.
This is a great reminder, though, that you will go through times when all of the above investing, and that's what we do when we put together a typical better investing portfolio. When we talk about having small stocks and medium-sized stocks and large stocks, and we talk about the fact that they grow at different rates and they have different characteristics. But my bottom line always is that you should expect the same thing from all of the stocks that you buy that you consider to be fitting the model of these up straight and parallel kind of things. This is nothing more than a graph of the value line arithmetic average, which is an equal weighted average. And then we're comparing it against our benchmark, the benchmark that we use consistently in most of the work that we do, which is the Wilshire 5000. And that's a capitalization, if you will, weighted average. And you'll notice that they track pretty closely to each other, but most of the time, the all of the above arithmetic average is just to the upside of the cap weighted average. And sometimes that gap can be considerable, right, Mark?
Oh, absolutely. I mean, basically what you're looking at, if you ask me to describe this in one elevator sentence, it would be that the Magnificent Seven, which has gotten all that press over the last several months, has still not caught up if you've got a long-term perspective. I mean, the orange area has still not caught up. It's close, but over a 30-year time frame, which basically encapsulates much of my investing experience and probably some of the people in the room. But this is the way we think of the world of investing. And I would also point out that it's pretty obvious that they take turns, going back over the years. Look at the go-go 90s. Some of us remember the performance of the Wilshire 5000 in the late 1990s. Well, you can see it right there. And you can see a little bit of a flat spot there for the last decade. So, okay.
You can even see the bubble bursting, Mark, if you look closely. All right.
You can. So that's just the point. Everything that you hear on the news about the Mag 7, they still haven't even caught up. And if we went from the right point, and I'm not even going to go there. All right. Just a quick moment to acknowledge some of the companies that have been the top company in our selections over the last almost 20 years. And first tip of the hat goes to Ty Hughes, who nominated NAPCO Security a year ago, and that has been the top performing, or that was the top performing company for much of the year. It fell behind over the last couple of months. In fact, Technoglass was ahead until the last day in October. So Ken was cheering for Technoglass, Ty Hughes was cheering for NAPCO. Ty wins.
They've both been wonderful investments, and in fact, there's been 3 or 4 at the top of our list from last year that were just terrific investments to hold. I know that's only 3 or 4 out of 20, but that's a pretty good batting average for double your money in 1 year stocks. So,
oh yeah, there were a handful of them, and again, the names going back over the years. There's some community favorites along the way. There's some somewhat obscure companies, a couple repeat performers on here, all the way back to Ken's. I believe he has grandchildren with middle names Neogen. Back to that. So just a lot.
Unfortunately, I related to Mark that I recently sold my last holdings to Neogen. It's not the company it used to be, and I would be very careful before entering that stock. I would do a lot of research before re-entering that stock again. They just don't seem to have been able to keep up with the added products that they acquired from 3M.
Yeah, and I don't know, just speaking anecdotally, I wonder if they're not having a little bit of trouble just executing with the 3M combination. And I don't know. Again, it's just something to be aware of and be watchful for. It could be the type of thing where they really do catch fire again with the 3M support, if that's what it is.
Absolutely.
Either support or interference.
It will take, it's not the kind of stock you just look at once and say, I want to own it. So take your time if you're going to study that particular one.
All right, so let's take a look back at the longer term track record. As many of you know out there, we have done this for a very long time. It actually predates this chart, where we would take the Forbes best small companies in America and go over them as a community and attempt to identify opportunity. Did a pretty good job of that. And then we woke up one morning. What year was that, Ken? 2015?
Oh, I don't even remember anymore, Mark, but it was somewhere in the middle of this chart.
Yeah, and they had orphaned us. They started tracking unicorns instead of best small companies, and we basically made the decision to basically look for the small companies as we always should have been doing anyhow, following better investing principles. So you can see here our best small company tracking portfolio has now won 14 of the last 19 years. For the trailing year, it's 42% versus 37. So pretty good performance. I will share with the audience that lead was as high as 20 percentage points at one point, and it went from 8% on the last morning to about 3% at lunchtime, and it was white knuckles, believe it or not. I would have never dreamt that would have been possible, but you can see over the longer term, this was pretty good outperformance, 1.5%, 2.5%. Outperforming it. But this is the period we really want to talk about, because when Forbes orphaned us, we began doing what we're going to describe here over the next few minutes. Basically focus on the fact that you didn't have to settle for roller coasters. You could find up, straight, and parallels. That's what we started doing. We had a 7-year winning streak. We were walking on water, and then we fell out of the boat in 2022 and 2023, along with a lot of other people. Small caps have been challenged. Small companies have been challenged for the last couple of years, but we now have won again. So it's 8 out of 10. And you can see that 10-year track record is basically 15.9 versus 12.8. That is not anything to laugh at. And in fact, as it says right there, roughly 5 or 6% of the funds that we cover have better performance. So that's again 30 out of over 600. So it's pretty exceptional performance, and we're just happy to be back. And somebody contributed a new bottle on that previous screen. We were driven to drink Dead Rabbit whiskey a year ago. So
That was compliments of our friend Pat from Pittsburgh, who suggested that was a great Irish whiskey we should be looking at called Dead Rabbit.
So we've moved on to Rose Rabbit to celebrate this year. So all right. So here are the companies that actually made that performance. What do you think, Ken?
Well, I'm looking over. We always track relative returns. So make sure, folks, and I do note a lot of new names to the list here of our attendees today. So do note that the normal total return is not in the last column that you're seeing on this chart. It's 2 columns in. So there's total return, and there's 4 companies that essentially in the last 12 months have doubled your money. They've raised about 100%. And you would have been happy with any one of those 4 investments. I know that some of you out there, quite a few of you, are probably invested in Western Alliance Bank. It's been a community favorite bank of ours now for 2 or 3 years. And the wise investors in the room knew that it was a small, conservative regional bank that was not going to go the way of Silicon Valley Bank or some of the other regionals. It was going to continue to do what it did, so that when its price dropped into the 20s, when all the banks went bust, when Silicon Bank actually folded, when all the banks dropped down into the 20s and then moved up to the 30s and the 40s, the smart investment clubs, and that would include 2 of the ones I'm in, were buying shares of that on a regular basis. 50 shares here, 100 shares there, a couple hundred shares somewhere else. And now that it's sitting around 85, maybe going towards 90 again, that's an extremely happy group of people that are doing that kind of investing. We discovered Tepaglass, Mark and I did about a year ago, just as they were moving to Miami from Colombia, a couple of years ago, right, as they were moving from Colombia to Miami. And it's proved to be another really great stock. I don't think NAPCO was on either one of our radars, was it, Mark, before somebody suggested that we look at it for the contest last year?
Yeah, Ty Hughes definitely brought that one to our attention. So again, thank you. The other one that we should point out is highlighted. That's Shockwave Medical. That came to us courtesy of Matt Spielman, and along with the one right next to it, Green Brick Partners. Those are both Matt Spielman inspirations. Shockwave Medical was purchased a few months after we started tracking by Johnson & Johnson. So we're happy to let them do that at those type of numbers. But other people in the
especially if it gives us 60% return, we are, yes. So.
We'll take that. So you basically do see a distribution similar to what we know as the rule of 5, that there's a pack of stocks down the middle that have performed pretty much close to market or our expectations. There's 4 superhuman stocks up at the top, and then there's a couple disappointments down at the bottom. And we tend to focus more on the A's on the report card than the ones with the red ink at the bottom.
And it's interesting that the one at the very bottom was the one that we had the least conviction about when we talked about it going into this contest last year, that we didn't know that much about it, but we knew that it had suddenly appeared on supermarket shelves, and it looked like the numbers were moving in the right direction, and we certainly didn't expect it to lose 40% over the next year as it did. That's Celsius Holdings, and I think it just goes to show that maybe some of the larger brands, the big gorillas, don't take to competition as nicely as they might. I think they put up a big fight about maintaining their market share, and it's been to Celsius' detriment in the whole process.
Well, I just want the audience to know that I am I've had too many cups of coffee, so I'm going to pour my Celsius beverage into my Yeti cup, and we'll move on here.
All right.
All right. Here's a look at the general guidelines. We're not going to go through these point by point. We're just going to hit some of the highlights. Um, yeah, we think that the same type of methodology matters. Quality matters, even for small companies. We like double-digit growth. We want the portfolio to be mid-teens on average. And one of the interesting things that we have done ever since we began this was Forbes would leave out financial sector or asset-based companies. And I couldn't do that because Ken would leave the room. So we figured out a way to do that. We're very thankful we did. We've had a number of regional banks do extremely well, but and we do tolerate 3 or 4 non-core positions, not the 8 or 10 that Ken tried to bring us here this morning, but a couple's okay.
Let's back off of that statement just a little bit, okay?
All right, he brought one extra one. Okay.
I do think that this annual revenues of less than $3 billion needs a little tiny bit of explanation. I know that the current orthodoxy in better investing is that a small company is less than $1 billion in sales in the most recent year, but Mark and I are pushing back just a little bit as you look at microcap funds, and as you look at small growth funds, small company growth funds and everything, they seem to have set the bar somewhere between 2.5 and 3 billion now. Inflation has changed that 1 billion number that better investing has lived with for maybe a dozen or more years. So we've kind of given ourselves some latitude, and we're pretty comfortable up to about 2.5 billion, and we might even push it up to closer to 3 billion if the company has some of the other characteristics going for it. So that's where that 3 billion comes from. It's not a hard and fast number, but we do think that the 1 billion is a little bit conservative in today's world.
Okay, and no penny stocks.
No penny stocks.
All right, so here is a vista of the places where we go shopping. We have a number of favorite lists that we lean on, and we will scour the better performing mutual funds who actively invest in the smaller company stocks. Pay attention to Fortune, Forbes. We love the small company screen at Better Investing, nested in the SSG Plus. And probably most importantly, those faces on the screen are places where ideas come from. Kevin Gologly took us through a great reminder of how much meat on the bone there is at the Hoover's Handbook, which you can get for free through most public libraries. You can get the PDF and take a look at the list. And we were blessed with contributions by Diane Grace, Betsy Wills, Matt Spielman, and Kim Butcher along the way here. So we just want to say thanks to everybody out there. And if I miss you, I apologize. But what's your favorite, Ken? Where do you like to? Where's your first place to go looking?
Well, I'm a great believer in lists. So whenever I get a list out of Fortune or Forbes, and I happen to be a subscriber to both magazines, I know that's a dinosaur behavior, but I like them in print. So when I get a list, I really spend a lot of time on a list that kind of makes sense. I'll even look at lists of the most admired companies, or lists of the best managed companies, things like that, because I think those are companies worth taking a gander at if they're treating their employees well, or if the outside forces think they're well managed. I think we should be looking at them. I use the SSG Plus small company screener about once a month, looking for new candidates to the screen. You become real familiar with it real quick because it only gives you maybe 10 to 20 companies on any given month, but you begin to see companies that stay on that list, and then you can pick out the ones that are new to the list, and those are the interesting ones that come up for me. We're going to have one of our stocks was given to us by a member of the Breakfast Club group down in Heart of Illinois chapter. They meet at 9 o'clock Central Time, 8 o'clock Central Time in the morning on every Wednesday morning. That's 9 o'clock Eastern. And that's a very interesting group to move to and to to go to occasionally and just listen to the things they have to say. One of our companies came to us right from the Breakfast Club there, Mark.
Absolutely. So Fortune didn't make it easy on us. And again, there's not enough time to do this. And one message I want everybody to take away is between now and the end of the year, the January effect is still in place. It's real. And I think it makes sense to not stop shopping. Of course, we're always shopping for small companies, but even more so this time of year, just keep doing it throughout the rest of the year. And you might find an interesting opportunity. Fortune gave us 2 days to work on their list, so we'll take a quick look at that. And then we want to cast a little bit of shade towards Forbes because they don't put out their new list until almost Thanksgiving, so that they earn the turkey. So the most recent one from them is from last Thanksgiving, so I'm just gonna give them a raspberry. All right, real quick look. Here's some of the leading companies in the Hoover's Handbook of Emerging Companies. The ones bolded actually are going to make our top 20. And you can see that we basically set aside anybody with sales that were approaching 3 billion or more, or with a company with single digit growth. And some pretty good companies survived that pass through the data. And Kevin is still out there going page by page. He started with the A's and he's going through the entire Hoover's Handbook. So we'll look forward to see if he comes up with anything else.
I'm at the H's right now.
You're up to H? Cool.
Yes, I am.
Will you make it by the end of the year? To the end of the book, you think?
Doubtful.
Maybe by Groundhog Day.
Oh, there you go. Could be some good groundhog candidates. The other place that we find very interesting is to go to Morningstar and the Russell 2000 Growth ETF, VTWG, as is shown on the screen. And Ken will take credit for the green circle. Explain the green circle, Ken.
Well, I explain it. I don't know exactly what you want me to say about it, Mark, but I do like to make sure that the company has earnings. I'm not looking at the magnitude of earnings on this list right here, but a small company that doesn't have earnings is, in my mind, a company that I'm not as interested in unless it can give me one heck of a compelling story with a lot of evidence that it's going to become profitable in the near future. That's a kind of a wishy-washy way of saying I won't touch a small company without earnings. And Mark has been trying to teach me to do that, and I've been very resistant. Okay.
Until that one exception here recently. No, I mean,
yes.
it's an important thing because there are 2,000 companies in this growth ETF, and you just apply the filter of I want to just look at the ones with earnings, and it really narrows the field down and helps with the hunt, in my opinion. So good stuff. Here's a third example. Here's that one that came out 2 days ago. So it's relatively new, but as you go down that list, I think this one passes the Kavula test pretty quickly.
Yeah, my test is I look at any list that I'm exploring, and if I don't see 4 or 5 companies that I'm familiar with, and maybe 1 or 2 or 3 companies that I actually own, then the list isn't something that I'm going to be using in any great way. Now's a great time to answer Bonnie's question that she asked a couple minutes ago. She wanted to know what the asterisk was for on some of these companies. And that just indicates a company in the manifest database that's not in the main value line. We've been a little bit lax at putting the asterisk on sometimes when it needed it, but we're trying to make sure that all the companies not in the main value line have an asterisk attached to them. That just helps you separate where you can find information for the particular companies that are listed. That's all.
Mm-hmm. So these are sorted by from highest growth to lowest, and there is a dashboard. You could go to that public dashboard on the upper right and take a look at the entire list. So with that, Ken, here are the companies that we selected for this year, and they're incognito for now. You can see that we basically have a collection of companies that have an upper teens growth forecast, upper teens return forecasts, pretty good quality top to bottom. We do like to watch for companies that are not swimming upstream. That's why we look at the projections for 2025 sales versus 2024 expected end year results. We like to see those numbers be positive. By the way, the average company is at about 9%. So we want to be above average there. And we don't pay too much attention to the 1 year analyst consensus because it's not reliable. I guess I could write an article about that.
It's not very reliable at all. No.
No, it's kind of amazing.
We have set a quality limit of 70 or better when we look at our core holdings, but you'll notice that there's a couple of qualities down that list there. There's a 69 and a 48 and a 19.7. And those are probably indicative of non-core holdings. And there is a holding without even data attached to the line. When we get there, we'll talk about that at a little bit at length, because it's kind of a change that we've made in our philosophy about trying to capture a particular kind of company. So we'll talk about that when we get to it.
Yeah, and what it comes down to is when I grow up, I want to be Jim Gallagher. Jim Gallagher is an investor down in Florida with the Space Coast bunch down there, and he is currently leading our stock selection contest, known as the Groundhog, and he's like 150% ahead of everybody. I would like to find one of those Gallagher stocks to make life easier. Maybe Ken would let me talk about the results more often, but we
should mention the name if you're going to mention the fact that he's way ahead, Mark. The stock is ASTS for those of you that are taking notes. Okay.
Yeah, his original Groundhog investment has gone from 200,000 to I think like 1.4 million, and he's doing pretty well. All right,
since February 2nd. Yeah.
So we're about half hour in, Ken. I think we're doing fine on the timing. I'll let you take us away with starting with our first bank on the chart.
Well, this is a regional bank. That little bar graph in the upper right-hand corner right there is showing 5-year total return for S&P banks in the western side of the country. And they have to have assets, or they have to have total return with assets of more than $5 billion. And the 4 banks at the top of the list happen to be Axos Financial, which you're going to hear about in just a little bit, Preferred Bank, which is this particular bank, East West Bancorp, which has been a community favorite of ours in the San Francisco area for many, many years. And there's our friend Western Alliance. And they're the 4 best total return banks in the entire universe of banks in the western half of our country. I'm circling some data that comes from the SSG Plus, and I'm just pointing out that bank data will not only give you the traditional sales, earnings, and pre-tax profit growth, but it'll also give you total asset growth. And for a good bank, what you always want to check is that the total assets are growing at about the same rate as the historical sales. And in fact, they are. Another way to say that is parallel, because I've put the asset line on this particular graph. That's the kind of aqua colored one right there. And you like it to be roughly parallel to all the other lines that appear on the graph. Just as you open up the SSG Plus. You'll also note under Evaluate Management, there's another metric down there called ROAA, Return on Average Assets. And the bank experts in our community have indicated steadfastly that this is one of the best measures of the quality and the management of a bank. A normal average run-of-the-mill bank will have an ROAA of somewhere less than 1. About 0.85 is a number you see written pretty regularly in the literature. When that ROAA goes up to about 1.25, you're looking at superb, excellent banks. And when that ROAA moves past 1.5, you're looking at a very small handful of banks. And if they're able to keep that ROAA up there for an extended period of time, you're looking at just one of the top handful of best banks. And that should be where you're making your selection when you're looking for banks to invest in. Preferred Bank has a lot of other things we could talk about, but this is the first one that we're putting on our list with an ROAA 5-year average of 185, with asset growth about 14%, and with a presence in Central and Southern California. They have a new branch in Houston, and they have a branch in Flushing, New York, and they're opening a branch in Manhattan. So Preferred Bank is both coasts, and now it's on our third coast, the Gulf Coast. And it's just a bank that I think you should take a very hard look at if you're looking to put a bank into your portfolio.
Cool. All right, so here is our annual slide to remember to check our emotions at the door. The history is pretty clear there. Cantel Medical disappointed us for 3 years, so we collectively decided to leave it off the next year list just because we were mad and angry at it, even though it looked pretty good as I recall, and it would have actually achieved a very decent return. How does that apply to what's going on here today? Well, on Tuesday at the roundtable, I presented Yeti Holdings, which is one of our best small companies for last year that has been a bit disappointing. And I just wanted to point out I am a Yeti customer, and I don't want to say that I'm upset over the 6% vote that I got, but hey, when Christmas comes around, or a year from now, I hope to be able to say in your face to this, this insult to get only 6%. I didn't. Here it is from last year. Here's the slide. Pretty good looking picture. Yeah, the price has been languishing. The profitability has been a bit under pressure. They're in a tough area. They have competition. Yeah, I know everybody could decide to stop using it. All that stuff is true, but their sales continue to go up, and they do make a good product. And the thing that I did not cover on Tuesday, Ken, that may have switched the vote in my favor was this notion that the real catalyst here is they are catching fire in China, Japan, and Australia. And they're working with some really good distributors. And what's cool about that is their penetration is actually fairly low in those areas. And other recognized brands obviously give them something to shoot for. If they can achieve that type of thing, I think we're going to see upward trajectory revisions on the right-hand side of this. If that happens, I expect to see a better looking stock price. So that's our second company. I'm going to be stubborn. I'm going to cite the moment of silence in Cantel and say, let's give it one more year, Ken, and kind of just let the red ink from 2024, we'll throw some salt in that wound and just press on.
Okay.
Mark, you were going to have no shot at winning when Ken came in with a bank at the round table. Ken with a bank and him doing the dance of the 7 veils. You could have had another bank yourself, and you were dead meat.
All right. Where's that mute button? Here we are with.
Stay tuned. He's bringing that bank back here this morning. So
here we are with NICE. NICE does a lot of software work. And when you read the company information paragraph on NICE, a lot of you will finish that paragraph and say, now, I'm still not quite sure what they're doing. But think of this as nothing more than a company that comes into your business with all the latest tools at its disposal, and then helps you make whatever processes you're using more efficient and helps them work with each other. So NICE does a lot of consulting work. I think that if you look at the IBARs on the visual analysis, you'll see that the company probably got a little bit ahead of itself going into the pandemic. And even though sales continued in a really great direction and earnings actually shot up even more steeply than they had during the pandemic, the actual stock price actually moved in the other direction. That's usually a setup for something going to happen in the positive way for the company. And I really do think that this company is positioned price-wise right now to really have a breakout at some point. I chose to put on this graphic from their investor presentation that shows that they've gone from being entirely focused on WEB, and I'm sorry, WEM, and I'll even give you the English words for that. That's Web Engagement Management. And that's just business speak for being able to look at what they're doing electronically. They've moved into analytics and then into the cloud and then into the digital cloud. And now they're working with products that deal with all of these different types of platforms. So they're ready to take you from wherever you happen to be in your business, and they're ready to take you right to the current day and maybe a little bit into the future. You see all the different modules they have working there on the AI platform, they call it. And I like NICE because it's been talking about AI before it became a buzzword for almost every company in the universe. The drawback, NICE is headquartered in Israel. And if that bothers you because of the problems that are going on in Israel, if you think that that might be a cause for the business to have issues, then you need to be aware of that. So NICE makes our list.
Yeah, and one other disclaimer.
And I should say that I'm a shareholder in this company. Go on, Mark.
Yeah, I'm also a shareholder. When I completed my study of NICE several months ago, I said, this all looks very compelling. The only thing that could go wrong would be if the CEO doesn't continue. He resigned a few weeks later. So they are in a change in management situation. He is staying on through the end of this year. But it is a change in management situation, and you should flag that and understand it. All right, so here is the company's name is D-Local. The ticker symbol is DLO. This is actually a Pat Donnelly nomination from the National Convention. Pat works as a management consultant in information technology. Nutshell version, these guys are a non-US credit card processing company. Again, I do not know a great deal about them in depth. What I do know is that they're competing against some pretty formidable competition out there. You can see that their sales and earnings trajectories are pretty good. You can see that they are obviously working with some very well-recognized and influential companies out there, and they are a tiny slice of this pie. Now, the stock price has been languishing, but again, those operating results have been pretty good. So again, this is a company that you might want to dig into a little bit deeper. It is very international. It does not have much U.S. business at all, but maybe that's something that might be attractive to somebody out there. So again, listening to a friend who works with this stuff on a day-to-day basis say, these guys seem to know what they're doing. The stock price has been weird. Okay. Speaking of Axos and the Tuesday night drubbing I took, here we go.
Well, this is the stock that I presented Tuesday night at the roundtable. I was quite negative on this stock 10 or 12 years ago when it was called Bank of the Internet. Some of you might remember it from right before the Great Recession of 2008. Axos Financial, they've renamed itself. The graph looks very respectable. And I'm not going to go over the same things I went over with Preferred Bank, except to say that, again, the assets line up pretty closely with the sales. 16.5 for historical growth over a 10-year period, 15.8 for assets, and their return on average assets, a 5-year average of 1.64, and the most recent number above 2. These are superb numbers. Axos operates in 3 different categories. They're a normal consumer bank, but they also have a large commercial bank dealing with businesses, and they have a brokerage, a securities arm that does traditional brokerage banking and deals with registered financial analysts. So Axos Financial, we'll put that on the list. Remember, in that chart that I showed you from Preferred Bank, Axos was the most profitable bank, with Preferred being the second most profitable in the West. Axos has no branches. They're a completely digital bank, no branches anywhere, and they have depositors in every single state in the union.
Mm-hmm. Very, very geographically diversified, and I was surprised to see that. And pretty good story. All right, let's go ahead and move on. If you're ready to move on to the next one, Ken.
Yes.
Not a company that I'm greatly familiar with, but again, I trust certain people with their opinions that play with this stuff all the time. In this case, this came to us via the National Convention a few months ago, and Susie Artsberger, who is the technology guru at Better Investing. And what we're talking about here is a company that basically is on the commercial side of social media and that type of stuff. I don't know how many times I have gone in and innocently typed in car rental or something like that, and the next thing you know, I'm getting hundreds of ads from all over the place. What these guys do is basically make sure that the customer is who they say they are, the provider is who they say they are, and they make an effort to, I was just basically price checking. I wasn't looking for a rental car in this case. So they try to figure that out. Now, Kevin Galogli basically took all of the ideas from the National Convention and put them on a public dashboard, 2024 Bank Stock Ideas. So you can go ahead and check that out. What I see here is just, again, fairly early stage company with the right trajectory for revenues and profitability. And again, down on the lower left and in the center, they are definitely dealing with and representing and trying to win the trust of some very, very formidable companies over time. You can see the trajectory of earnings and sales is pretty good. And this is kind of a counter AI type thing. And there are some negative things out there, perils, if you will, in the realm of AI. And this is a company that's trying to use AI to make things better. So the ticker symbol is DV. The company is Double Verify.
Mark, I just want to add one thing to the business explanation. One of their biggest products, one of their biggest services is making sure that the client's advertising doesn't end up on a bad quote unquote website. So for example, one of their clients is Bacardi. They would not want to have Bacardi being advertised on an Alcoholics Anonymous website.
Absolutely. Or perhaps in front of children or something like that. Who knows?
Yeah, so that's what one of their biggest jobs is, even more than some of the other things that they talk about doing. This is where they got their start, and they still make a lot of their money doing just what I explained.
I did send them a note and ask them to double down on their efforts with Yeti in Australia and China.
Okay.
Next.
This is United Therapeutics. It's a biotech. It's a company that actually has profits. You can see the blue line on the graph. And you can see since the pandemic, the earnings per share and the sales have been pretty robust for this company. They have one particular area of healthcare that they're extremely interested in, and that's pulmonary arterial hypertension. This is hypertension, but it's focused on hypertension in the blood vessels that connect the lungs to the heart. And it's an extremely serious kind of hypertension. And it's something that's not as rare as you might expect. Some of their most popular drugs, in fact, the first two on their drug list right here, speak to this particular condition. and they're drugs that are the most prescribed by physicians for these particular conditions. They're the most prescribed drugs that exist. Now, they do have some smaller drugs in other fields, one of them in infant oncology, but most of their thrust is in this pulmonary arterial hypertension. They seem to have a pretty long runway, a fairly decent pipeline, which they will go to great lengths to explain to you on their website. It's and a very, very dense website full of lots and lots of information, especially if you can wade through some of the medical jargon that accompanies some of the drug trials and everything. So we're looking at a small biotech that's profitable and making very decent earnings per share.
Good progress. We should also mention that this idea came to us via the Investors Business Daily New America feature, which can be interesting. They do basically a weekly feature on upstart promising company. That's where this idea came from. All right, next on the list. Okay, this one won't take long, Ken. Green Brick Partners. It's been on the best small companies for the last 3 or 4 years. Again, inspired by Matt down there in Houston. And the one difference between this year and last is they did curtail their Colorado adventure. And I suspect they may go back someday, but for whatever the reason, maybe, Matt, can you shed any light on that?
Yeah, Colorado is their only partnership. So this company has grown, although they've moved to their homegrown brand, Trophy Signature Homes, which is a entry-level homes. They grew by acquisition, and they acquired, much like Berkshire Hathaway, looking for partners rather than just to buy it out and put their shingle on there. So Colorado was the only one at the time that they were a minority partner, was 49-51. And so their majority partner just decided that he wanted to go it alone or didn't want to partner anymore, and so bought them out. So yeah, Denver has had, if you look at the markets they've had, they were probably the slowest, although they were still great. And they were primarily in Colorado Springs, just planning to enter the Denver market proper.
Okay.
So it was in development. It's too bad it happened, but then interestingly for me, they then focused first on expanding more into Austin and then also Houston. So I think that's where they put their money for that.
Yeah, and on the right side of the chart, obviously, with what's gone on with mortgage rates and just a general economic environment, it wouldn't be surprising to see a little bit of a flat spot in the revenues and earnings, and they have managed their business pretty well over the years. So Green Brick stays on the list for this year. Thanks, Matt.
Mm-hmm.
This is ACM Research. This is an American company with significant presence in China. They also have significant manufacturing presence in Korea. What they do is they're offering services to chip makers. And if you want to break it down to the most simple explanation, think of it as offering cleaning services. They have machines that will help clean off chips that have been made by other companies in other locations, and most chips that are being made need these cleaning kinds of things to happen for them to operate properly. Now, there's a lot of technical language in the description, and they don't have as good a website as I would prefer, but they do have a website to explain a little bit about their process. I like the up, straight, and parallel nature of the visual analysis that I'm looking at in the bottom right here. And I will say that about 2.5 years ago, there was some chatter about some things going on in the company that were not very well taken by the market. It had been reported by some short sellers that various things had been happening. I'm trying to stay vague because I don't want that rumor to continue to be spread. It was shown that it was basically rumor, and that did happen 2.5 years ago. So if you're looking on the web for information about ACMR, make sure you check the dates of the sources that you're reading, and make sure you're looking at stuff that is relatively current within the last year about the company.
Yeah, and in related news, Demi Moore and Michael Douglas no longer work at the company. No, that's a different movie. Same type of company, same type of issue, though, keeping the chips clean. One of the things to also think about here is these guys, if you're having trouble deciding on a semiconductor chip company, these guys provide services to a bunch of them. So you're kind of spreading out and hedging your bets and chasing a good thing. All right, our next company is Cactus, ticker symbol WHD. This is our Rocky Mountain Memorial pick or commemorative pick, inspired by Betsy Wills and Ralph Futch and the Rocky Mountain chapter of Better Investing. It's been part of their model portfolio for years. Ken and I tend to think of the company as a wannabe or a mini Schlumberger or Halliburton. They do make the hardware for the production of natural gas and oil, petrochemical type stuff. You can see that the visual analysis on the left is a little bit bumpy, but definitely up and headed in the right direction. So this is a company that has been covered by Betsy and the Rocky Mountain team. Compelling. What the mystery that I have, Ken, is they acquired Michigan's own Flex Steel a little while back, and I'm not seeing the connection between recliners and what they're doing. So it might be interesting to watch this one or see what Betsy has to say about this in the future.
And that's a real head scratcher, Mark. I don't understand that at all. Okay.
I'm guessing that one of the Bender brothers actually was in Grand Rapids and decided to buy the company. I don't know, but good picture, good area of opportunity. We'll also have a Len Douglas moment here. Len is constantly pointing out, or frequently pointing out, that the need, no matter what happens with EVs or any of the other stuff, the need for petrochemicals is going to be pretty constant and pretty reliable. The demand's going to be there, so this is an opportunity to invest in that field. And if you can't warm up to Schlumberger or Halliburton, perhaps this one is right up your alley.
Well, we did get from our audience, Mark, the note that Flex Steel was used in a lot of RVs, but that still doesn't tie us to the oil fields. So
I did see a brief explanation where they have a certain kind of very specialized pipe that may have used some Flex Steel resources to actually make this retractable metallic pipe. So whatever.
Okay, we got another question from Bonnie about what's the percentage of banks that we're going to put on our list, and we've tried to keep the banks to only 1 or 2 on any of our lists, so that would be at the most 10% of the list. So you've seen the end of the banks on our list now. We're just going to other companies, and this one is EXLS, or Excel Services, I think is the way they pronounce it. Another business management company, but much more into IT. They can point to IT as far back as 2021, and they were actually using, and I said IT, I mean AI, right? They can point back to it as far back as 2021, where they were actually using the term and bringing their customers up to date with whatever was available. This is from Peak Matrix down in the bottom left down here. They'll do a ranking of the different companies that are involved in this kind of stuff. And you can notice Excel way up there in the upper right-hand corner, which puts it in a very, very envious position in regards to the competition that's on the rest of the graph there. So it's well regarded. It's been around for a long time, 25 years, and it has a lot of different platforms. You'll notice that one of their big thrusts when they're trying to build their business is to upsell their customers and add new platforms as the customers become more sophisticated with using AI tools. So you can see the progression, the step progression going on with the different kinds of tools. This is a company with a very, very dense website, some really good investor presentations. And if you're interested in it, I would suggest you take some time and learn about how long the company's been dealing with AI, how successful it's been in actually transforming AI to the bottom line, to the earnings per share line in the company, and what their plans are for the future. I do own this stock as well.
Yep, and it's in the roundtable collection also, and it gets pretty high marks from people who work directly with these type of companies, including a couple of my neighbors. That's anecdotal. All right. Here's a company I really don't know much about at all. And it kind of sprung on me. I ended up with it because Ken abandoned it as we were going over the list. Not much track record, very promising though. And I have actually used ChatGPT to give you some information there on the right, which will give you a bunch of their buzzwords. And they're working on the keyword here is obviously data centers and optimizing power consumption, all that kind of stuff. So I asked somebody, a family member who works in this line of work, if he had any familiarity with them. And then I asked him to explain it to me like I'm a fifth grade. He says, okay, go back 15, 20 years and think about light bulbs. I said, okay, I'm on it. He said, do you remember when they were all incandescent bulbs? I said, yeah, sure, the old style light bulbs. He says, well, you realize that those were basically 10% light and 90% heat. And so that's the type of efficiencies we were dealing with. And we began switching to these LED bulbs and various different kinds of things. When you do that, and you can actually reduce the electrical consumption. The utilities have actually seen this, right? So he says, same thing here, only they're doing it with chips and they're doing it inside the data centers. So they're basically taking and truly optimizing power consumption in the guts of the operation. So that does help me understand that these guys, it's obviously an important area. And I told Ken that if these guys are using graphene, if you're not familiar with graphene, you might want to become familiar, because if a company comes out there and strongly commercializes graphene, read up on it and understand it and watch for it. We do it all the time at bull sessions. So this one stinks to me a little bit, a little more speculative, definitely early stage. CRDO.
This stock came to us from CNBC, believe it or not. I was listening to a woman that ran a small company fund, and she indicated it was her largest holding in that particular fund. Unfortunately, at the time, I didn't think it was something I really wanted to look at, so I didn't write down the name of the fund. But the idea itself, the CRDO, was written on a pad of paper and brought back to my computer. And lo and behold, I liked the concept, and we talked about it then in this context of small company lists.
Ken sucking me back into the CNBC world. Oh boy. All right, here's one I'd never heard of, but go ahead, Ken.
This is Vera Mobility, and they do pretty normal kinds of things. They provide a lot of the traffic cameras that you'll see in large cities. They do a lot of toll management for rental car companies. So they'll handle problems that your fleet might have with paying tolls. They'll make sure that the tolls are paid so you don't have problems with extra charges or anything like that. And they're also a provider of software to help large universities deal with their parking issues. The major universities, especially those that are inside of the city limits, have a lot of problems many times with parking. And Vera Mobility is one way that they're able to do some of the control of that parking through electronics. They're also moving that particular system into small to medium-sized cities to help them manage small parking lots without the use of aids in the parking lot. You've You've maybe gone to a city the size of Savannah, Georgia, or Charleston, South Carolina, and you've noticed many quarter block lots with no parking attendant, but they have directions on how you can get a parking space electronically to make that all happen. Most of their business obviously is in commercial services and government, but parking is becoming a larger and larger part of their business and is growing at a fairly decent rate. I like the up, straight, and parallel nature of the visual analysis, and I give you Vera Mobility, VRRM.
All right, so I'm not a customer, but I've been a target here because when I drove my wife's company vehicle where I shouldn't have, they eventually catch up with you. On to more pleasant topics. All right, innovative solutions and support. The ticker is ISSC. This is we have to stretch for this one. This is down to a very specialized, relatively small company. So we are channeling the Mocon world of Charles or Chuck Allman. It's okay to own a really small company if they're doing some really cool stuff. And these guys basically are in the cockpit of the future business. I have some sentimental attachment to this because we have actually worked with people at Motorola who invented the touch screen for aviation in back at the University of Illinois many years ago. So the touch screens were invented. Now it's obviously moving on to next generation type stuff. They also do things with drones, which I think is a pretty high demand and promising area. The picture down on the lower left is in Sweden or Belgium. I can't remember which, but it's an agricultural application using a drone. You see some pretty nice trajectories for the sales and the earnings, and a company worth keeping track of. Definitely. Aerospace and defense, think drones, think next generation navigation. And for this also works for Betsy's, Joby, and that kind of stuff too. Probably. Next, a repeat.
This is a repeat. We've had MedPace. I'm in two clubs that own MedPace, MEDP. You can see their revenue comes from some sites that are pretty recognizable. A third of it from oncology, a lot of metabolic problems, cardiovascular problems. What MedPace does is it works hand in hand with pharmaceutical companies and biotech companies, and it works them through the entire process of regulation. Drugs have to go through an extremely complicated process, and even getting to step one takes a lot of effort and a lot of paperwork. And MedPace actually assumes the responsibility for a lot of this testing that goes on to help a drug become something that finally goes to market. MedPace is a very well respected company, and their revenues have been growing nice and steadily for a number of years. It's been around for a reasonable amount of time. If you want much more information, they also have a very dense website with a really, really easily understood investor relations presentation. So take some time on MedPace. This is certainly not going to go away. The creation of new drugs from our source, Mr. McManus out in Pasadena, AI is doing nothing except increasing the possibility of finding new drugs. And that means more business for MedPace, not less.
Excellent. All right, so here's one of our much more speculative situations. This is the company that Ken was referring to that we learned about through the Wednesday morning breakfast club, Central Illinois. Steve Emmerich runs the breakfast club, and Janet Blazer brought this company to our attention. The picture says it all. If you're familiar with EpiPens for especially our grandkids, we have one grandchild that has a peanut allergy, so we're very, very familiar with the EpiPen. What this company has come up with is a nasal spray, which accomplishes the same thing. I think it's worth noticing. And again, more people are likely to use this product. Very, very early stage, but it's potentially cheaper. It's got better shelf life, and again, very attractive from a cost standpoint. The sales projections are strong, but again, very preliminary. And Ken looks at it from the perspective of a former high school administrator or school district administrator, and all the school districts out there have to have a certain amount of this device based on the number of kids, and they have to keep them fresh and up to date. And it's a fairly significant expense for the school district. Am I on base or on target here, Ken?
You're walking down the right path. Yes, Mark. Uh-huh.
Yeah, so it's a interesting area, and the fact that so many people would be more likely to use it, and just a very interesting thing. The name of the company is ARS Pharma. The ticker is pronounced Spray, SPRY.
Mark, I think the biggest plus for this thing is that the reluctance of people to actually plunge a needle into somebody's thigh. I know that when we talked about training people on something like this in faculty meetings, I would watch as much as 2/3 or 3/4 of the faculty just cringe from the concept of wanting to do that, especially to a small child. And I think that if they were given the opportunity to use a nasal spray rather than plunging a needle into somebody, that the choice would almost 100% be, let's use the nasal spray. I'm not cringing about making that happen, especially in a little skinny leg of a second grader or something like that. So there's a lot of pluses for this thing, and this company does have the beginnings of some earnings, just the very beginnings of some earnings right now.
Yeah, they are projected to be profitable in 2025 or 2026, and it'll be interesting to see how the adoption cycle goes. But put it on your radar screen to follow along and continue to evaluate the investment. So we'll move on to another holdover from this year, almost a two-time champion.
Here's our friend Technoglass. I don't see anything stopping this company. I'm just going to indicate that since we last spoke, they have now moved into vinyl residential windows, which has a large addressable market, and they have virtually no share in that at the moment. But with their reputation for different kinds of glass, they can then put the different types of glass that they have, and they have a large number of different types of glass. They can now put them in these vinyl windows for residential construction. And I think it's just one more avenue towards making the company more profitable. They still have the large, very large construction production plant down in Colombia, and the ships from Colombia still come back to the U.S. With a lot of the material. And since they used to come back from Colombia almost empty, they get extremely good freight rates on the shipping of the finished glass material back to their home headquarters in Miami. And then they're branching out into the rest of the U.S. right now, and they're putting offices in other parts of the U.S. I own this company. I'm in 3 clubs that own this company, and it's been treating us really well in the last 12 months. Notice that the price is up near the top of the 52-week range. So I think the market is anticipating some taking off in the price again as well.
Okay. All right, we're definitely in the speculative zone here a little bit. This is a company that's been on the list for a couple of years, and I'll tell you what. You talk about backing up and looking at it, see the trees. This is a company that's been on our radar screen for the better part of 10 years. Hugh McManus, who works in the field, first brought this to the roundtable back in 2015. And they basically, since then, have proceeded to fully develop 2 solutions for the market, one for irritable bowel syndrome and the other for dialysis patients to hold down their phosphorus. But what I find fascinating, Again, we've been tracking it on the roundtable. Many people within the community. Ken, I don't think we were necessarily aware. The most recent update, or at least a fairly recent update, has taken the financial strength up to B plus. Obviously, there's a pretty decent pattern taking shape on the right-hand side here with respect to expected sales. They were hammered by the decision from the FDA back in this time frame, going from 10 back down to about 50 cents a share, that they have lived to survive for another day, and they do seem to be coming out of it. The price targets do seem to be headed up this way, and in fact, just on Halloween, they had a quarter where they were break even, which would be basically a couple years early if they can continue to have that level of performance. So I was a little bit stunned to see that this company has become less early stage, less speculative than I tend to think about it every day. I do own a considerable number of shares of this company, as do others within the community. So it's there. It's been interesting. It's been fun, and look forward to what tomorrow holds. And the graphic is from Sean Mace, who thinks that's all of us looking for the next report from Ardelyx up on the upper left. All right, couple more and we're done. One more repeat.
This is Iradamed. I discovered it in just doing some searches. I really, really like the concept of this company. Most of you know that you can't take metal into an MRI situation, and that means that if you're going into an MRI from intensive care, perhaps, you have to be unhooked from your monitors, you have to be unhooked from any kind of IV that you might be dealing with, and unhooked from anything else that might have metal attached to it. Iradamed has created patient monitors and infusion pumps that are non-ferrous, non-magnetic. And what that means is that you don't have to be unhooked. It's revolutionary for the MRI situation. Any hospital, any lab that has an MRA room will be looking for this kind of equipment. Notice that since the pandemic, when things really slowed down, but since the pandemic, notice that sales and earnings have been very robust in the company. I think it's a high growth kind of small company, and if the management can keep things on an even keel, then that growth that began back in 2018 and that was interrupted by the pandemic can continue on that trajectory for at least the next 3 or 4 years. Again, non-magnetic, non-ferrous tools to use in the MRI, and that includes all the gadgets that are consumable, all the tubing, all the clips, all the needles, everything that goes along with the monitors and the infusion pumps are non-magnetic. Very interesting company.
Yeah, and in fact, we've mentioned them a couple of times here now. The Wednesday Morning Club is actually led by Steve Emmerich. He is a retired MRI technician, and in fact, his email address is MRI guy. So he has commented that this is a legitimate enterprise and expectation. All right, I think we're closing down. Am I right? Closing down with this one, and this is the one I was teasing Ken about. He's got this infatuation with Oklo, OKLO, and it's a great looking company. Upper right, you can see what they're trying to do. Basically a nuclear utility, but they don't have sales or earnings. So
I'm just going to do some name dropping, Mark. They do have Sam Altman as the chairman of their board.
He's a smart guy.
He's a real smart guy, and they evidently know what they're doing. Folks, if you pull up an SSG on Oklo, you get a single dot. There aren't even any sales. They just went public back in June, but I think it's worth a real serious look at where they're trying to go. This particular company. I'm going to name drop as soon as you talk about NewScale too, Mark.
Okay, well, NewScale. I actually own shares of NewScale. I mean, this is one you talk about FOMO, fear of missing out. I have actually been sort of praying that these companies don't get away from us, because we started looking at this stuff a couple of months ago and bought a few shares of NewScale at like $11 a share, and I believe it was over 20 or in the 20 neighborhood yesterday. So what name are you going to drop on me?
Well, the name I'm going to drop is Bill Gates.
Oh, Bill
And
Gates.
Gates
I've heard
is,
of him.
yeah, yeah. And Gates is doing a demonstration project in Wyoming where he's using a reactor, just like NewScale is talking about building, and retrofitting a coal-powered generating plant. That's what NewScale wants to do. They want to retrofit some of these coal power plants with these small modular reactors. There's the ticker, SMR, small modular reactors. This is not new technology. This is old technology with established supply chains and with established places to end up with fuel. And the really interesting things is that they're looking to make this thing use some different kinds of fuel that we had thought was lost to the market entirely.
Yeah, and you can see for scale, the thing is, you can put it on a tractor trailer on the lower right there. So really, really a neat technology. They're not like the mega nuclear reactors of the past, and interesting concept. I also added this one on here. This obviously is a brand new exchange traded fund. The ticker symbol nukes, as it's shown up there, and they touch on GE's power division and a whole bunch of other suppliers, including architectural companies and engineering companies. But Cameco is a uranium miner and provider. And again, I'm taken back to about 6 months ago when at one of our bull sessions, Herb Lemkool, one of our Mid-Michigan directors and very successful investor, basically said you need to be looking at these actual uranium companies. So you're basically capturing all of the above with this ETF, and there has been a shift in how Washington D.C. is treating this subject. It's an area that Kevin has a lot of experience with, and it's definitely a shift change, sea change, wind change.
That uranium comment was in response to the fact that for almost a year now, I've been extremely interested in hydrogen as a potential fuel for automobiles, and in the idea of these small nuclear reactors being used to in processes that can turn methane gas, that's CH4, into pure solid carbon and pure hydrogen. And if you can put all that technology together and make that happen, we end up with a building material for roads, pure carbon, and we end up with something that you can bottle like propane and trade out like propane and use as a relatively fast way of refueling an internal combustion engine without having to sit around and wait for 45 or 50 minutes for the charge to refresh itself. Yep. Also using known technology, not using revolutionary new technology.
Yeah, and they are working in those areas also. But the thing to take away here, just recently, within the last few weeks, Google has announced a power purchase agreement based on these technologies. Other data center type companies are thinking along the same lines. So again, it's part of a number of themes, including electrification and the data center theme. So
we should make it clear, this is an ETF. This includes shares in maybe 25 or 30 different stocks. And here's the top 10 holdings.
Yep. All right. So with that, here's your summary of the 20 companies that we have presented. And you can see that it's a pretty formidable bunch. So that provides the names and the tickers with the slide that we presented earlier. All right. So with that, Ken, we close down with a look at one of our favorite Michigan landmarks. You've probably been there. Did you stop by there recently on the left?
This is Mackinac Island, right, Mark?
Painted rocks up on the
Oh, that's
Lake
Pictured
Superior.
Rocks? No, we did not stop by
Pictured Rocks.
Pictured Rocks. No, no.
I know you did that drive tour, but that's Pictured Rocks
Yeah.
on the northern shore of the northern peninsula, Upper Peninsula, and that's Lake Superior. Although I object because that looks like a peaceful lake to me, and I don't believe it. I think it's been the photograph's been altered because on the right is the Lake Superior that I know, upper right. And I know it up close and personal from being on that thing in a kayak. And don't send me notes about Mark, you're doing it wrong. I've got probably 100 emails telling me I'm doing it wrong. But yeah, that was an interesting
And you're
moment
not
to
going to listen
remember.
to him, huh?
I'm not going back, Kevin. Lake Superior, it is a beautiful place. If you're looking for places to visit, it truly is spectacular. I'm not giving it enough credit. So it really is a neat place. So with
Well, and
that,
Mark, I've seen the lake. I've seen the lake in both pictures. So
Yep.
it can be one thing one day and the next thing the second day. So
and you're probably wondering what's this got to do with investing. I think when you're in the realm of these best small companies, you can experience either one of these conditions, and you just have to be prepared and not surprised by that reality.
we've kept up with the question box pretty well, Mark. We've answered most of the questions that were asked. We did get another idea to put on our list from, let me pull that up real quick, from Douglas, and he's suggesting we look at GLDD. So you might put that one on the list just to take a quick look at that at some point. And with that, I think we're ready to shut things down and get our Saturdays underway. Okay.
All right. Well, thanks. Hope you all enjoyed it and have fun digging into these companies. And I no longer can do price or performance updates unless we get a Gallagher stock taking off and covering for them. So good luck out there, everybody. Enjoy your weekend. Again, retroactively, happy Halloween and happy Thanksgiving a few weeks from now.
Good afternoon, everybody. Have a great weekend and have a great Halloween. Oh, you already had that, didn't you? Okay.
Yeah, we're still celebrating here.
Yeah.
Take care out there, everybody.